The UK housing market has long been seen as unshakable, but now cracks are appearing. Mortgage payments are soaring, prices are stagnating, and experts are warning of a collapse that could wipe out hundreds of billions in wealth. Is Britain on the edge of its biggest financial crisis in decades? Welcome to UK Economic Report, your go-to channel for the latest updates on the UK economy. From inflation and interest rates to housing trends and government policies, we break down the numbers so you can understand how they impact your finances. To understand why the housing market could be at risk, we have to travel back to the roots of Britain's property boom. Over the past 20 years, house prices have soared at rates far exceeding wage growth. In London, in particular, the price of a typical home has more than tripled since the early 2000s. Investors, foreign buyers, and speculative developers poured money into the market, convinced that property in the UK could never lose value. The mantra "houses always go up" became gospel. Families stretched their budgets, often taking on mortgages they barely understood, confident that the rising tide of property values would carry them safely along. But every boom contains the seeds of its own fragility. The first warning signs appeared during the pandemic. The government's stamp duty holiday and ultra-low interest rates supercharged demand. Prices shot up in a frenzy as buyers rushed to secure homes before rates increased. The market became hyper-competitive. Bidding wars drove prices beyond what average buyers could realistically afford, and regional disparities grew even more pronounced. Yet at the time, few worried about long-term consequences. Property had always been a safe bet. What could go wrong? Fast forward to today, and the landscape has shifted dramatically. Inflation in the UK has soared to levels not seen in decades, prompting the Bank of England to raise interest rates aggressively. For homeowners, this means mortgage repayments are climbing fast. Those with variable rate or tracker mortgages are facing sudden and substantial increases in monthly payments. Household budgets that were already stretched thin are now under immense pressure. For many, the dream of homeownership is turning into a nightmare of financial strain. The ripple effects are already visible. Recent data suggests that mortgage approvals are declining, house sales are slowing, and asking prices are starting to stagnate. Economists warn that if this trend continues, it could trigger a sharp correction in property values. Unlike a gradual slowdown, a sudden correction, what many call a crash, could wipe out hundreds of billions in household wealth almost overnight. For families who borrowed heavily to get their foot on the property ladder, this could mean negative equity, where their home is worth less than the mortgage they owe. Human behavior magnifies these economic risks. Fear is contagious. Once buyers and sellers start to believe prices may fall, the market can turn on a dime. Sellers rush to offload properties, buyers hesitate to invest, and a feedback loop emerges that accelerates the decline. Britain's housing market, which once seemed unshakable, could be vulnerable to exactly this kind of psychological collapse. History offers sobering lessons. In the late 1980s, Britain experienced a property crash that left thousands of homeowners in financial ruin. Interest rates had risen sharply, property prices plummeted, and the economy slipped into recession. The trauma of those years still lingers in the collective memory, a stark reminder of how quickly stability can crumble when debt, speculation, and economic pressure collide. Today, many analysts fear we are treading a similar path, but on an even larger scale. Given the unprecedented levels of household borrowing and the inflated prices of today's market, the implications of a crash would extend far beyond individual homeowners. Banks, which hold the vast majority of mortgage debt, could face significant losses. Property developers and construction companies could struggle to stay afloat, triggering job losses and a slowdown in economic activity. Local councils that rely on property taxes and development fees might see revenue collapse, impacting public services. In short, a housing crash in the UK would not just be a financial story, it would be a human story of anxiety, uncertainty, and widespread hardship. Some economists argue that the market may self-correct without a dramatic crash. They point to regional variations. Not every part of the UK has experienced the same level of price inflation. While London and the South East have seen astronomical gains, northern regions and smaller towns remain more affordable. If price adjustments occur gradually, the economy might avoid a catastrophic collapse, allowing buyers and sellers to recalibrate without widespread panic. However, this scenario depends heavily on confidence, government intervention, and interest rates, stabilizing factors that remain highly uncertain in the current climate. Government policy also plays a crucial role. Over the past decade, successive administrations have attempted to make housing more accessible through schemes like Help to Buy, shared ownership, and first-time buyer incentives. While well-intentioned, these policies have often fueled demand without addressing supply, inadvertently inflating prices further. Critics argue that unless housing supply increases significantly, particularly in high-demand areas, affordability will continue to deteriorate, leaving millions priced out of the market and increasing vulnerability to a downturn. Foreign investment adds another layer of complexity. The UK has long been a safe haven for global investors seeking property as a store of wealth. While this inflow has helped keep the market buoyant, it has also amplified volatility. Geopolitical tensions, changes in currency values, or shifts in international investor sentiment could trigger rapid capital flight, causing prices to tumble. In essence, the UK housing market is no longer just a domestic concern. It is intertwined with global flows of money, making it more unpredictable and fragile. Amid this uncertainty, the human stories are already unfolding. Families are grappling with the prospect of rising mortgage bills. Young professionals face years of saving just to afford a deposit, while older homeowners worry about how a price correction could impact their retirement plans. Investors who once relied on property as a safe asset are nervously reassessing risk. The emotional and psychological impact of a housing market in turmoil is just as significant as the financial consequences. So, what does the future hold? No one can predict with absolute certainty whether the UK housing market will crash, plateau, or gradually correct. The signs of strain are undeniable. Rising interest rates, high debt levels, affordability challenges, and a history of boom and bust cycles. Whether these factors culminate in a sudden crash or a more measured slowdown depends on a delicate balance of economic policy, market confidence, and human behavior. One thing, however, is clear: the UK housing market, long seen as a bedrock of stability, is facing its greatest test in generations. What happens next will shape the financial lives of millions and redefine the nation's economic landscape. It is a story of ambition and risk, of dreams built on debt, and of the fragile interplay between human psychology and economic reality. In the coming months and years, the UK housing market will not just tell us about property, it will tell us about the nation itself, its resilience, and the high stakes of the choices we make in the pursuit of home and wealth. Thanks for watching UK Economic Report. Don't forget to subscribe and hit the bell icon to stay updated on the latest UK economic news, expert analysis, and financial insights that matter to you.